right? All right. Tax advantage accounts. So how many of you have a Roth IRA? A person does. Cool. All right. 2 people, unless that same person just moved up and down, I'm not quite sure. Yes, 1 person keeps moving around. This is like Hollywood Squares or something, except the dynamic Hollywood Squares. Oh, and someone's raising an actual hand, a real hand. All right, not a virtual hand. All right, so anyway, let's look at different kinds of retirement accounts. A retirement account is not a kind of investment. A retirement account instead is a special shield put around a pot of money that can be invested in lots of different ways. So you could invest a retirement account in stocks, in bonds. You can invest in individual real estate, like you can go buy a house with an IRA. You can invest in gold and Bitcoin, right? All sorts of things you could invest in if you wanted. Your company stock, you could, but I say no. So a retirement account, or let me just actually call it a tax-advantaged account, because there are lots of different kinds, is a special designation on some form of account that you could do investing in. Commonly, it's in stocks and bonds, like, in the stock market, in index funds, in mutual funds, but it doesn't have to be. A tax-advantaged account, so let's look at normal money, okay? You just have non-tax advantaged, non-advantaged. You put money in, the money that you put in, have you paid taxes on it? Yeah, you had to have put taxes on it, so I'm going to put a frowny face here. You put money in, okay? And then the money goes in and it grows over time. So we've got, let's say, the money that you put in plus growth. The money that you put in, when you take it out, do you have to pay taxes on it? The money you already pay taxes on, do you have to pay taxes again? No. This money comes out happy face. This money with the growth comes out mostly sad face. But remember we talked about long-term capital gains? So if you make an investment and hold it for at least a year, the money that comes out can be at a better tax rate than might otherwise be. So it's slightly tax advantaged. Okay? And I don't even mean when you come out. I mean actually as the growth happens. If you buy some stock and sell it a year and a day later, then you owe taxes. Even if you say, but it's still in my account, doesn't matter. You realized the gains. Okay? Let's look at tax advantage. Let's look at a traditional IRA or 401k. In the traditional IRA and 401k, it's cool because you don't pay taxes on the money going in. So you might say, I'm going to put $15,000 into my 401k this year, and that's $15,000 reduced off of your income for the year, and it's money you don't have to pay taxes on. It grows over time. One hopes that actually the yellow is much bigger than the blue, right? That's always what you want, is you put in a small amount of money and you get back a large amount of money. As you withdraw it, that's when you pay taxes. Does that make sense? But it's as you withdraw, not as you buy and sell things. So here, you bought some stock, and a year later you sold it. You have to pay tax on it. Here, you buy stock, you sell it, you buy more stuff, you sell, you buy more stuff, you sell. It's tax deferred. So you're deferring taxes. It's only when you actually withdraw it that you have to pay tax. This tax deferred can be extremely valuable because if you are buying and selling things regularly, having this friction of having to pay taxes every time means you are reducing your compound growth, right? Exponential growth characteristics, right? If you're making 12% a year on this, buying and selling, then you're completely compounding that 12% over however long you keep this. Here, you have this drag of having to have 12% minus your taxes. So you may be only getting 9%, let's say, as you go. And so that can make quite a difference over time. This is one kind of investment. Does this make sense? So when someone says fund an IRA, this is what they mean. You get to deduct as you're going in, and you have to pay on your way out. There's another possibility, and that's a Roth, named after, I believe it's Senator Roth, sometime back in the 90s maybe. So there's Roth 401ks and Roth IRAs. Here, you have to pay income taxes on the stuff that goes in the sense that you don't get anything special that happens. Normally, you just have to pay income tax on everything, right? But in this case, we say no, whatever you choose to put in here, you actually can not pay taxes on. Here, you still have to pay taxes. It grows over time. I'm going to just have fun with this, and you get a lot of growth, right? It's no different from this one. I just like to show more growth. And now, when you withdraw it, sorry, I was about to use red. It's not red. It's all blue. When you withdraw, no taxes. So pay taxes now, don't pay taxes later. Or don't pay taxes now, pay taxes later. Does that concept make sense? Which is better, this one or this one?
The second.
It depends. It really depends. So let's say you're in a high tax bracket now, and later on down the road you expect to be in a low tax bracket. Then it might be better to get the tax savings now, invest that tax savings, and you would end up in a better place than you did here. On the other hand, if tax rates go up in the future, you'd be much better off here. You do have to just hope that they don't change the rules of the game with the Roth IRAs and start taxing you later, right? That's one advantage here. You get the deduction now, you know you got it, you have to pay taxes later. Here, you have to hope they don't change the rules. It's unlikely they would, because there's so many people that have so much money in Roth IRAs and Roth 401ks that they'd be pretty pissed. Okay? So, how much can you put in these vehicles a year? Does anyone know?
Some percentage of
for
income.
Roth.
Oh.
Some percentage of your income, actually, not exactly. Okay, $6,000 per Roth IRA. Roth, exclusive or regular IRA. Exclusive or meaning you get to choose one or the other. Okay, not 6K, both. So you can say for $6,000 I can put stuff in my Roth, or I can put stuff in my regular IRA and get my deduction. Except if you make, so today, if you got money and you wanted to put it in an IRA, which one would you guys do today?
I'd pay taxes on it now because our tax bracket is most likely lower than it will be in the future.
You are hugely low tax brackets these days, I assume, unless you guys are amazing students that I don't know about, but okay, that have lots of income. Normally, you don't have very much income, and when you don't have much income, Roth is great because you're not paying much tax here. Part of it depends on how much money you have, but in any case, you could put in your Roth or your regular. Here's the problem. There's an income limit, and you guys are going to hit it. And over that income limit, you can't put in your Roth IRA. And if you do put in your traditional IRA, it turns into a red here. So pay taxes now and also pay taxes later, which is not very good. But it doesn't matter because there's a workaround. And the workaround is what's called a backdoor Roth IRA. So there is a limit for how much you can contribute. You just can't contribute to the Roth if you make too much, but you can contribute to Roth IRA, but I told you in this crappy way where you pay taxes, right? No limit on contributing in this crappy way. There's also no limit in converting from a traditional to a Roth. And if you've already paid taxes on it, there's no new taxes. So basically what you can do, and you can just look up back to a Roth IRA, you make too much money, you put money in a regular IRA, and then a week later, you convert it to a Roth IRA. And all of a sudden now it's in your Roth. Okay. So another nice thing about, go ahead. Yeah.
Just wondering if you could clarify what you mean by like the income limit. You mean like if you make enough money that you want to put in more than 6K?
I'm saying if you want to get the tax advantage treatment for putting it in, that is, if you want to either contribute, you just can't contribute to a Roth directly if you make more than so much money. I don't know what the number is. It's around 100,000. You just can't put it in. Okay. And the intention was, we don't want to give this vehicle to folks who make a fair amount of money. Okay. Same thing in the traditional IRA. We don't want to give you the tax benefit of this contribution. So if you make more than whatever this number is that I'm not telling you exactly because I don't know, but you'll hit it, then we don't want to have this. But there's just this loophole that is well known and well exploited, which is you can put it in here, pay taxes, and then convert it into a Roth IRA. And then all of a sudden it gets this nice shield, and when you withdraw, you're never going to pay money. Okay? So backdoor Roth IRA, that's what you would look up. All right, so we can put $6,000 in, regardless of our income, we can put it into a Roth IRA because of this backdoor. So we can either put it in directly, like today, if you don't make much money, or we can also put it into the backdoor. Okay, so that's $6,000, and I'm going to just say Roth IRA. And we just remember this is, maybe it's doing the backdoor deal. Let's get rid of, let's get rid of some of this. How much can you put in your 401k, according to the IRS? Okay, your company, well, companies normally actually don't have a limit. So I have sometimes put 100% of my paycheck into my 401k. So I started a company like in October, and I wanted to get my maximum in, and so I just said, take it all. So the number, when I looked up, was $19,500. 19,500 that you can contribute to 401k. And that's either Roth or traditional, up to you. But wait, there's more. Okay, so that has to come out of your paycheck. And so you would normally just, sign up and go say, this is how much I want withdrawn every month. And then you're just not going to be taxed on that. What else sometimes happens with a 401k? So your employer likes you to have a 401k, and so they'll often do a match. How much? And the answer is it depends. Yeah, usually they'll do a percentage. So some companies will do like, 6%. Whatever you put in, they'll put in 6% more. Some companies, Google was 100% match up to, I think, like $8,000, and then 50% match beyond that. Okay? But that runs into a question. What if you had a company that just said, you know what? I'm going to just match you like 5 times as much. So you put in 19.5, I'll put in another 80K, and you're going to end up with basically 100K in here, none of it taxed. Would the IRS like that? No. So there's a limit. The total in the 401k per year is limited to $58,000. That is your elective contribution. So you're the one that you get tax benefit on. So this is either you get tax benefit because you put it in a Roth, or you get tax benefit because you put it in your traditional and get to deduct it. It'd be cool if you could do both, get a deduction and put it in a Roth, but you don't get to do that. So it's the combination of elective contributions plus employer contributions. I used to work for myself for many years, and I had this so generous employer, right? They would always do the full amount up to the maximum that you could put in, which was less in those days. Okay. It, of course, was just me being generous to myself, but nonetheless, it was good. And then finally, after tax. So you might get 19.5. So you might get 19.5K from your 401k. You might get, just let's say we're generous and we get a 10K match from your employer, and that leaves 29.5, almost $30,000 more in your limit here. Depending on how your 401k is set up, and at most tech companies, they're set up well, you could put another, what is it, 28.5 into what's called a mega backdoor Roth. You put it in your traditional 401k and pay taxes on it, and then you can roll it over into a Roth IRA or Roth 401k. So what this means is you can put up to $64,000 a year tax advantaged every year. This helps address one of your main expenses. And what's one of your main expenses? Or what is probably your top expense? Your yearly expenses, taxes, are probably your top, right? Probably more than lodging, housing, probably more than transportation, probably more than food. And so this helps save a lot of that. Okay? Some of it's you're saving now, some of it you're saving later. While we're here, let's just because we can, let's throw another couple $1,000s in here. Okay? So let's throw $3,500 in an HSA. Anyone know what an HSA stands for?
Health savings account.
Health savings account. That's right. So you has to be paired with a high deductible health plan. Most big companies will have such a plan. That'll be one of their options. And one of the disadvantages of that kind of a plan is you have a very high deductible, like $3,000 deductible. So the first $3,000 of your medical expenses, you pay. You can pay them from the HSA. So any money you put in the HSA actually looks really cool. So the HSA is happy going in, and even with the growth, happy going out. As long as you're paying for medical expenses, you never are paying taxes. You never pay taxes to begin with, and you don't pay taxes on the way out. I'm going to talk about how to hack your HSA in a moment. And I'm going to also talk about the fact that if you're putting in $58,000 a year, after 10 years, how much money do you have?
At least 580,000.
At least 580,000. If you're making an 8% return, your first $58,000 has already doubled, right? And your second $58,000 has already doubled. So you've actually got, more like instead of 580, more like 700. Just counting the first 2 years. And then if you counted the rest of the 3, 4, and the 5, you could plug this into a calculator, an amortizing calculator, and figure out what it is, right, roughly. But what that says is if you work, 20 years, you're going to have a boatload of money, right? You're going to have multiple millions of dollars of money. However, you started working at 22, you're now 42, maybe you're done. Maybe you would like to actually live a life of leisure or something, or go work for the Peace Corps, or go teach computer science at some small engineering school or something, right? And so you've got a problem though, because these tax advantaged accounts have a limitation on when you can withdraw money. Anyone know how old you have to be before you avoid a 10% penalty?
65?
59 and a half. Okay? But I'm going to show you ways to get around that. Ways you can pull it out whenever you want. Okay? And avoid the 10% penalty. You can always pull it out as long as you're willing to pay both taxes and a 10% penalty. But if you don't want to do that, I'll show you how to do it.